and Arno Weberman, the head of investor relations. I'll now hand over the call to Arno. Arno, over to you.
Hello and a warm welcome, everyone. Thank you for joining us today. Before we begin, just a quick reminder that today's discussion may include forward-looking statements which involve risks and uncertainties that could cause actual results to differ. With that said, let's walk you through today's agenda. We will start our presentation with an overview of the key messages from our CEO, Filippo. Then our CFO, Mario, will take you through the financial performance for the quarter. After that, we'll be happy to open the floor for your questions. Let's get started. Filippo, over to you.
Thanks a lot, Arno, and good afternoon, everyone. So let's go through the presentation. It has been another important quarter for Alamar with a growth in terms of sales and profitability. This is now the third quarter that we are showing a growth, and this time we're showing also a growth in all the key clusters and all the brands that today we are operating. If you can move probably to the next slide, please. And again, this for us is very important because as we always shared with you in the past few quarters, our focus was on consolidating the current Alamar, on making the current business model more agile, showing a growth in terms of sales and profitability, to then move to the inorganic growth. So, and we are still pursuing this direction with some very important achievements. So basically, year on year, we have been growing from quarter four, was 1.6% in terms of total sales growth. In quarter one, 2.1%, and now in quarter two, we're talking about a 4.5% growth. As I mentioned before, the growth is recorded in all the key markets and our clusters. So the growth is still in Saudi Arabia. This is the second quarter that we are showing a growth in Saudi Arabia. The same in other GCC and Levante countries. And there is also an important growth in North Africa. This growth is driven by Dunkin' in Egypt. In terms of store rollout, also here we are following the guidance that we shared with you. So far, H1 2025, we opened 15 stores. There are 17 stores that are under construction, 10 that has been already, let me say, negotiated, that will go under construction. So we are still forecasting to close the year with 40 plus new stores, those as corporate stores. In terms of EBITDA margin, also the EBITDA margin is showing an important trend year on year and quarter on quarter. As I mentioned before, there is a growth in both brands, Domino in the range of 3% growth in the second quarter, year on year, Dunkin' almost 40%. Also here to track where we are compared with the H1 2023 and in general with the 2023 as a year. This is for us is an important reference as we have been sharing also in the past few calls because this is the period before the boycott. So now in H1 2023, we have also recovered another half of the gap. So the H1 2025 is only 7% behind the H1 2023. And we are forecasting to go in the second half completely aligned with the second half of 2023. We mentioned in the past about all our program to become more efficient and more agile. This time we wanted to share with you some important KPI, also to show you where we are and the progression and the improvements that we have done. So the first focus is in the cost per order. So by managing our costs and by making our costs more flexible, not only as a fixed cost, we have been able in Q2 2025 to reduce the total cost per order by 42%. And this is a very, very important achievement that you can see also on our gross margin and profitability. In terms of technology and IT, we have been working. Finally, we are deploying now also the self-ordering kiosks that are in a pilot in UAE. We have signed an agreement with a Saudi company to use AI for everything related to real estate. And this includes both relocation, but also new stores. We are more and more deploying our WhatsApp as a chat box, not only to manage the complaints, but also to place the order and to help the customers to track the order and to have a more efficient and productive customer care. Again, we are introducing also variable delivery fees on our app. This means that the customers, by reaching a specific threshold, they can have a free delivery available, and this is encouraging the customers to increase more items into the basket. And then again, we are more and more evolving the e-wallet. So we are transforming the e-wallet into our loyalty program, and there are new features that are available in the e-wallet. Also, what we have done in the second quarter, and this also respecting our timeline, is to leverage properly our omnichannel business model. That's why today we are focusing also on carry-out promotion. So basically, we do compensate the customers through the e-wallet in the moment they decide to order carry-out. And again, this is a way for us to keep a focus on all the channels, the sales channels that we are available online and also physical. In terms of store economics, as you see, we are now developing new stores. We are opening new stores in a very more efficient way. So in the last 3 years, we have been able to reduce our CapEx per store. That is already, let me say, quite limited because it's not an important amount, but we have been able to reduce this by almost 11%. Always a focus on new product development. As a Domino, finally, pasta is available. We have been talking about pasta in the last 2 calls. Now it's available. We are finally running a pilot in Saudi Arabia that is somehow showing very good results. And we are getting ready to deploy the product, at least starting from the GCC country. Also, we tried the croissant pizza. That is a new crust that is available in Morocco. This is for us still a safe-to-fail experiment. All of these, always keeping in mind the engagement with our community, and we have done important activities with Saudi students in Saudi Arabia, with a partnership with Kinam, that is a program for Saudi talents. As well, we have renewed the partnership with the SAI Foundation for people with disabilities. Here you can see some pictures about our recent new stores. These pictures are here only, let me say, to emphasize that yes, we have been able to reduce the CapEx per store, but by enhancing the customer experience and by enhancing the design for both concepts, for Dunkin' and for Domino. For both concepts, we are also now more and more working on a different format. But again, the idea is always to have a high standard and to communicate properly to the customers, to engage also with the local communities. This is, in a nutshell, is a sort of resume on what I said before. So Domino, as a percentage of sales in Q2, still represent the 92% of our total sales. Dunkin' is at 6%. There is a slight increase. Dunkin' was in the range of 4 to 5%, and now is 6%, thanks to the great performance, especially in Egypt. As a store count, you can see that we are growing a number of stores for both brands. So we are adding 10 stores, each one versus 2024 as a Domino, and 5 stores as Dunkin'. Also, what is important is that 60% of our group sales today are from Saudi Arabia. 88% of the sales are pegged to the US dollar. And also those are very important for us in terms of stability and the fluctuation from the currencies. The next slide. So here the focus is always on our omni-channel business model. This is a slide where you are getting more and more familiar because we are updating all the information about this slide. Here, what are the key takeaways from these slides? That the aggregators are now at 38% of our total sales mix. As you can see, and this is a very, very important, the sales on our Golo platform, on our own platform, is constant. This means that the aggregators, where the percentage is also because there are newcomers, new joiners as aggregators like Kita, are expanding our order count, so there is no cannibalization. But even the new aggregators are adding audience to Alamar and to our brands. And again, this is an important element that we are keep monitoring. Then, as I mentioned, we are keep evolving our app, this for Domino and for Dunkin'. As you can see, today the total digital revenues have reached 71% in Q2 2025. They were 68% in Q2 2024. A few years ago, those were 50%. So again, this is very important for us because digital sales means for us also to know better our customers, where we can leverage more our customer database and our CRM. So that's why, again, this ecosystem also will help Alamar in the future. I leave now the floor to Mario to go through the financial performance, and then, as anticipated by Arno, we remain available for your questions.
Thank you very much, Filippo. Good afternoon, good evening to everyone. Thank you for attending again to this earnings call, for your continued interest in Alamar. Filippo was summarizing a little all the main points, and I think it's clear that we started 2025 in a very good way. And this momentum has continued in the second quarter. This is supported by the increase and recovery in our revenues, improve in our operating leverage, and we have continued with this cost discipline that we have been doing during the last periods. As a result of all this, and as we can see here in this table, which I think now we are all familiar with, most of our all our major P&L metrics has been improved and increased. Revenues rose 5% to reach 200 million reals. Gross profit increased as well by 3%. Adjusted EBITDA, as we can see, grew 10% to reach 29 million reals. Philippe already mentioned, and I think it's important for me once again to remind this, to repeat it. This is the third consecutive quarter in which our margin continued expanding. More important, we are able to continue translating this into a stronger conversion, and this conversion into earnings. Net profit to shareholders rose 17% year on year to reach 15 million, while the adjusted net profit grew 20% to reach 17 million reals. Important operating cash flow continue increasing year on year, and we have reached 38 million. Despite, and Filippo was mentioned as well, the ramp up in our CapEx and new open stores, which is in our pipeline. On top of all this, we have delivered a free cash flow of 29 million real SAR in this quarter. Our net cash position remained strong, with total 73 million real SAR at the end of this second quarter. The year day-to-day decline, but this is mostly reflected on working capital movements, dividend payments, and seasonal effects, which will be normalized in the next periods. I just briefly going to comment that the equity figure that it was disclosed very recently in Data Pool is being under review. Any change is going to be disclosed closely. But this is clear, it's not affecting our performance, any of the figures presented, cash flow or dividends. We can now move on and talk a little more about our store counts that we have referred already. Well, Filippo mentioned it already. The situation on the geopolitical environment is improvement, the improvement of Alamar as well. We have accelerated the store rollout in the second quarter of 2025 with 10 new corporate restaurants, 7 for Domino's and 3 on Dunkin'. There are also as well 2 new franchise restaurants opening during this last quarter. As we can see on the bottom right, they increased the total stores count 3.9%, and we reached a total of 719 restaurants, including 549 on corporate restaurants at the end of this 2025. Domino's restaurant account for 90%, as we can see in the table top right, of the total store count, while the remaining 10% are Dunkin' restaurants. Corporate stores represent 70% of the total stores, the rest for franchise. In terms of geopolitical breakdown, KSA continue being our major market with a total count of 41% of our total stores. Corporate store in GCC and Levant accounting for 17%, while corporate in North Africa accounted for 18%. Franchise restaurants represent 24% of all these accounts. Now, let's move on and let's continue digging and talking about our performance. Okay, in this slide, we are going to talk about the revenue. Filippo briefly mentioned, it's important to mention that our net revenues continue being 88% pegged to stable currency, the US dollar. And Alamar has delivered a solid line growth in this second quarter of 2025, with revenues that has reached 236 and 37 million real SAR, or 4.5% increase year on year. This performance, and we briefly mentioned, has been supported by the continued momentum, the good momentum in Saudi Arabia and the strong rebound in North Africa. Saudi Arabia posted its second consecutive quarter of year-on-year growth, with Q2 2025 revenues rising and increasing 2%. We have continued enhancing the brand marketing and improve the customer experience. North Africa, on the other hand, delivered the highest growth across all our footprint, with 26% year-on-year increase. This was largely due to our Dunkin' strong performance in Egypt, new product launches, and of course, a more favorable exchange rate. In the GCC and Levant, revenues rose 3% year-on-year, reflecting the continued brand activity and the improved regional stability. For this first half of the year, our revenues reached a total of 448 million reals, representing 3.4% increase compared to the same period, half a year of 2024. Now is a moment to talk about our EBITDA. Okay. In this second quarter of the year, we have delivered another step forward in our profitability. Adjusted EBITDA, we have seen it before, rose nearly 10% year-on-year to reach 29.5 million real SAR. This marks, I'm sorry to repeat it again, our third consecutive quarter of year-on-year margin improvement. We continue with our disciplined cost control and strong operating leverage. Selling and distribution expenses declined compared to the last year, driven by a more focused and impact-oriented media strategy. Aggregator commissions, yes, continue increasing in line with their growing contribution to our sales. It's important to highlight that this channel remains profitable and strategically important for us. Altogether, these trends highlight the structural improvement we have achieved in the business, our transformation efforts, especially cost discipline execution, and continue to enhance the flexibility and efficiency of our operation model. Please now let's move to our next slide and let's have a look to our net profit. In this time, we are going to be talking about the net profit attributable or directly to our shareholder, excluding minority interest, to give a more accurate view of our group underlying performance. As we can see in the table, Q2 net profit shareholders rose 17% year-on-year to reach 15.3 million real. This includes, and it's important to mention, a non-recurring in G&A, general and advertisement expenses. Adjusted for that, underlying net profit reaches 16.6 million. In our next slide, we will be discussing a little about our cash. As we can see in this slide, net operation cash flow reached 38.3 million in Q2. It's almost 3 times last year's level. This is supported by the higher profitability and working capital influence. Capital expenditures rose to 8.9 million from a low base in Q24, and this is reflecting what we have commented before, our ramp up in opening and developing new stores. All this combined results in 29.4 million real in free cash flow under IFRS 16 reporting. It's important, again, one more time again, that Alamar remains a debt-free company with a healthy net cash position of 70.3 million real. The board also approved dividends for 12.7 million in line with our commitment to deliver consistent results and returns to our shareholders. Now we are going to go to the last slide. I think this slide now we are quite all familiar with it. As usual in this slide, we analyze the dynamics of Alamar average daily sales, and it's always rebased as general to the January 2023 for a consistent comparison, let's say. In Q2 25 and July 25, we saw a strong revenue momentum with post-Ramadan daily sales increase of around 4% above the same period if we compare it with the same period of the previous year. Although somehow, as we can see here, growth somehow decelerated in July in line with common seasonal pattern, the dynamics remain very positive year-on-year for us. This is our last slide. This is what we have to explain now, and we open the floor for all your questions. Again, thank you very much for attending this meeting and for your attention.
Thank you, Mario. Thank you, Filippo. So as a reminder, you can use the raise hand function to ask a question, or you can also type your question in the Q&A box. So we have our first question from the line of Usman Siddiqui. Usman, please go ahead.
Hi, thank you, management, for the opportunity. I have 2 questions. First one is on the revenue growth. Can you give us the revenue growth on a like-for-like basis, adjusting for Ramadan impact? Because 2Q24 had 10 days of Ramadan, so if you could give revenue growth excluding that impact. Secondly, when you talk about second half, closing the gap between sales for second half 25 and 23, you are talking more on a full company level or on a by the store level? And my third question, if I may, is on the margins. You showed a very strong improvement in cost per order going down by around 42% from first quarter 24. But somehow the expansion in margin is limited. So can you guide or explain the reason why the cost per order decline has not been translated to the expansion in margin by the same amount? And that's it.
Sure. The revenue grow, also with the limited growth that we had last year in terms of new openings, more or less total sales growth is very close to like for like. When we look to H1, somehow Ramadan is out, but if you wanted to have a number, is in the range of 4% as a growth, net of any seasonality. And this is driven by volume and by also average ticket per transaction, not because we increase the price, but because again, thanks to our promotion, the customers are adding more items to the basket. When it comes to the second half, what we shared is the revenues, the top line at the group level. And this is driven by stores because we don't have other revenues except the sales to end consumer. When it comes to the margin, the cost per order do not include all the costs, but include only the direct cost. This is because, again, the company on the other side is also in investing in brand equity. The company is investing also in human capital. The company is also investing in technology. That's why what we are doing as exercise is to completely reshape the P&L because we know that there are some costs that we can manage as well. We know that there are some costs because of the investments that we are looking at that we need to onboard. What we are doing is to make sure that we are decreasing the costs more than how much we are somehow investing. Because again, for us, it's very, very important to grow the market shares and to consolidate our presence, especially on the key markets where we are operating now.
All right, thank you.
So as a reminder, you can use the raise hand function and ask a question live, or you can type it in the chat box. So I think we have a question in the chat box. What was the base CapEx 22? That's the question.
Sorry, Ankur, I lost you a bit.
Can you repeat it? Yeah.
So what was the CapEx per store in 2022, right?
Yes. Okay, go ahead. Sorry, Filippo, go ahead.
So the CapEx per store, it was always in the range of $150,000. And this is somehow an average that works for both brands. So today we are moving into a reduction of this CapEx per store. This again, as I mentioned, without impacting the customer experience, the store design that totally is getting elevated. Now, how we achieved this? We achieved this working on two important components. One is the negotiation with the supplier tender process, also giving them a clear pipeline of investment to make them also more efficient. This is the kind of way that we always build a partnership with our suppliers and vendors. On the other side, also by moving to smaller store. Smaller store, this again, driven mainly by the digital sales. So the sales are becoming more and more digital, and this gives us the opportunity to penetrate the neighborhoods also with a smaller store than before. This also not to leverage all the real estate that is available and also the new sales channels that are available.
All right, that's very comprehensive. Thank you, Filippo. Our next question is from the line of Nishit Lakotia. Nishit, please go ahead.
Yes, thank you for the opportunity. My question is more on the aggregator cost. How much is the delta that you've seen year on year on the aggregator commissions in your costs? Because it seems like you've been able to manage that cost growth at a much reasonable level despite a lot of incremental sales coming from the push by aggregator, as you have mentioned, in terms of more aggregators also coming in and expanding your base. So is there some deal that you have with the aggregators on maybe possible lower commissions, or how are you managing this cost? Otherwise, this should have been a big chunk of incremental sales, or rather some material chunk of the incremental sales from this channel. So that's the first question. And second, on the competitive environment in Saudi Arabia, how do you see it currently versus what it has been, say, 6 months back? Are you seeing much more different options coming in for the customers to choose now from competitors and similar products that you have possibly in the fast food? Or that's not something that you are worried about, or it hasn't changed much in last 6 months?
Thanks a lot, Nishit, for your question. So the first question is about aggregators. I mean, I can say that on aggregators, we are benefiting somehow from the competition that is also now in this ecosystem. We all know that Kita has entered successfully in Saudi Arabia. By September, they will also enter in UAE, and then they're going to expand in the GCC, looking to Bahrain, Kuwait, Qatar. So this somehow has generated to us a double benefit. One, let me say, directly on our P&L in terms of commission, because again, competition is always important. On the other hand, also helping us to explore audience that were not on the existing aggregators. That's why when Kita has entered the market, yes, they took market shares from the existing players, as well they expanded also the pie for the entire aggregators. For us as a company, and this is our strategy, aggregators is one of our important channel in the omni-channel business model. We worked in a way to make this channel profitable and eventually more profitable. How? By addressing the promotion differently than on our channel, by understanding the kind of audience that are ordering from aggregators and how this audience is different from the audience in our own channel. And all of these kind of, let me say, enrichment and insights today are more available also, again, thanks to the competition between aggregators. As you can see also from the presentation, on the other side, we are keeping the volume on our own channel that are also growing because the overall order count is growing. So to keep the same percentage means that also the orders on our own channel is growing. And today we are also focusing on the carry out. The carry out, in a moment where everyone is looking at digital sales, is also an important channel that now we are addressing with a specific promo for the carry out customers. The second question is about, let me say, the landscape or the F&B landscape in general in Saudi Arabia. We know that this is evolving in terms of opportunity for our customers, is also evolving as customers' behavior and the new F&B trends that are coming. That's why for us, MPD is very, very important because, you know, the environment from one side is, let me say, challenging. On the other side is giving us opportunity, and the opportunity like a new occasion, a new channel, new audience, different kind of engagement with each audience. This is how we are going to position the brand. So the kind of work that today we are doing is a kind of, let me say, marketing activities that help us to generate volume and help us to generate sales. And at the same time, help us to position the brand and to associate the brand to everything new that is in Saudi Arabia. Could be e-games, could be any kind of, let me say, new seasonality, let me call in this way, that today is also available in Saudi Arabia. That's why now we are also developing a product with local chef. We are more and more using local ingredients. Pasta for us is an important category because it can increase the frequency and can help us to penetrate more specific time during the day, like lunchtime. So all of this is coming now and is available. We are testing, and this makes us not comfortable, but at least we are happy with the results that are aligned with our, let me say, plans, which are with our plans.
Understood. Thank you so much.
All right. I think we have a question from Abdullah Al-Wahabi. I think you partly answered it, but maybe you can elaborate a bit more. Despite a significant reduction in cost per order, it's not reflected in the company's margin. Can you highlight why this is the case?
Yeah, as I mentioned before, because I mean, when we look about the cost per order, we are allocating only the direct cost to the order. So basically, we are mainly talking about the food cost, store labor, marketing, and aggregator fees for the channel of the aggregators. So we are not including, again, investment in human capital that goes under G&A, and let me say, we're not including investment in technology or any kind of other costs that we are today allocating in our P&L for the future growth of Alamar organically and inorganically.
Yes, and if I may also add this, two quick points. For instance, and this is in line with what Filippo was mentioning, we have seen a clear reduction on the delivery cost of this. And secondly, when we are saying that it's not reflected in the company margins, well, as we have been discussing during the presentation, our net profit, gross profit has been increasing, okay? Just to point out this.
All right. I think just take two questions from the chat box before we move to Sultan. So I think there's a, is there any update on the M&A activity that was shared earlier? Is the first question. And I think the second question also I'll ask now is that, I mean, is there a guidance slide? Is the forward guidance for the medium term still the same as previously mentioned, or any change there?
Sure. On M&A, we are keep working always in the direction that we have been mentioning in the past few calls. There is something that is coming that hopefully we are able to announce in the next few weeks, probably before month end. And again, you will see that we are always consistent with our announcement. So the kind of acquisition that we are looking at is an acquisition that will help us to consolidate our presence in Saudi Arabia. And again, this is very, very important because we still see an opportunity also to increase our market shares in Saudi Arabia. So this is what about M&A. About the guidance, we are moving as we shared the last time. So for us, the first step is to close the gap with 2023. Because this is very important for us to have a strong foundation to then do some important inorganic growth. We always shared with you that we are looking to grow not as a way to mix between the current performance and the future performance, but for us, growth needs always to be profitable, and we want to approach the inorganic growth, especially the big one, by having a solid foundation on the current portfolio of Alamar. That's why today we are happy to see that Saudi Arabia is growing, that North Africa is growing, that GCC and Levant is growing, both in sales and profitability, still generating an important cash flow for the company.
All right. Sultan, please go ahead. The line is open.
Yes, hi. Thank you for the call. Hi, Filippo. Hi, Mario. Just a question on the performance of the stores in the first half 2025. When we look at the overall sales, it grew by around 4%. I'm just wondering how much is the like-for-like growth in the first half versus first half of last year? It seems like there is it's a challenge to generate or accelerate the like-for-like sales. I'm just wondering also, where is this issue coming from? Are you experiencing it in Saudi and other GCC countries? And just an indication, how do you see this going forward?
Yeah, hi, Sultan. No, as I mentioned before, more or less the 4% is also our like-for-like growth because we didn't open so many stores to change materially the view between total sales and like-for-like if we compare year on year, first half with the first half, but also quarter by quarter. These 4%, if you remember, even last year we were always mentioning that, especially when we look at Saudi Arabia, that the sales were flat because from one side we were growing the order count, but not the average ticket per transaction. Not because of a competition, but in general behavior of the customers. Today, again, we are in a different situation where there is a sales growth that will remain in the range of 4 to 5%. But this time, this sales growth is with the combination of both order count and average ticket per transaction. This is very, very important because it means that, let me say, in terms of market shares, we are not reducing our market shares because the order count have been increasing over even the past few years. So irrespective of except during the deep time of the boycott. So this is very, very encouraging. The second is that the customers are appreciating our value proposition and they are adding more items to the basket. So that's why today the average ticket per transaction is moving because finally the customers are adding new items or more items to the basket. This is driven also by our promotion because especially with the mix and match, where the customers can combine 3 items at a very valuable price. This again is very, very positive. This combined also with the reduction or the control on the commodity price. Why today we are also able to push on this direction? Because the commodity prices are more under control. Therefore, somehow what we are doing in a fair way, we are sharing with the customers a portion of the savings that we are seeing in the food cost. So this is This is the way that we are engaging with the customers in the long term. Instead of applying, let me say, formulas like shrinkflation or reviewing the portion, no, we are getting more generous with our customers. Yes, making sure that the gross margin in absolute value is increasing. Why this? Because after the gross margin for the sales of the product, most of the costs are still fixed. So that's why by having more sales with a higher gross margin per order in absolute value is also very healthy for our P&L and profitability.
Very clear. Just on the raw materials, you mentioned, and obviously have done a great job on that front. I'm just wondering, going forward, do you expect any headwinds on that front?
No. So far, no. We have closed almost all the key tenders for us, especially when we look to proteins, to cheese, and we're not expecting anything. Let me say we had some tension for the logistic because we were using Dammam as a port. But then we directed all the goods from Jeddah. So, but again, this is a situation that are always happening, and again, we are quite flexible on this. We are keep investing more and more on deploying a local supplier. This for us is also very, very important also to manage properly the working capital, not only to take the cost under control.
Very clear. Thank you so much.
So I think we have a next question from the line of Pratik Khandelwal. Pratik, please go ahead.
Hello, am I audible?
Yes, Pratik.
Yeah. So in Q2, there was some softness in the gross profit margin. Yeah, can you explain like what was the reason? Because like you just mentioned that commodity costs are trending downwards, and you haven't added like new stores over the last, not much of new stores. So what is the reason for that? And uh, so yeah, I'll get back to the second question later.
Sure. This was driven because in some important markets outside Saudi Arabia, we have been testing a new value proposition. So that's why we did some exercise to understand the price elasticity. Yes, investing something in gross margin, but always making sure that the overall P&L was under control. And this we will explain eventually to you later in Q3, Q4, once this strategy is set. Now we are planning the communication of this strategy with our customers. But again, this goes into the direction always to generate growth through volume by, let me say, providing more value to our customers.
Thank you. Second, I think you were having some difficulties in the recent past to get royalties from from the players in Kuwait. So how is the situation now? Are you getting those royalties, or still we would see spike in the receivables? And the third, the question is on the appreciation of Egyptian pound of late. So should we see Egyptian revenue that should show up in the Egyptian, I mean, in terms of the revenue and profitability to improve from Egypt, or you are seeing the prices offsetting any benefit from the currency appreciation?
No, I mean, you can see, let me say, a spike in the receivable. These somehow confirm that there are some markets that are recovering, and with these markets, we have also a repayment plan. You will see that some of these receivable will be somehow materially reduced after also we do announce some inorganic growth. And so I cannot disclose with you all of the details, but you will see that again, some of this receivable is one of some of the targets that we have in mind that, again, will help to consolidate, especially the market shares, and to grow in a very profitable way, especially in Saudi Arabia. The second is about the Egyptian pound. I mean, for us today, what we are making sure is that the business in Egypt is profitable and is also self-funding from a working capital point of view. We have been able to localize all the items. Therefore, when we look to the P&L of Egypt, is Egyptian pound in revenues and is also Egyptian pound in terms of cost. I will say for 95% of the cost. And this make us somehow protected in terms of profitability. Yes, there could be some other devaluation. We are always monitoring this. That's also the reason why in Egypt today we are not doing a mass investment in terms of new store opening. But in Egypt, we are having a very cherry-picking approach in terms of location to make sure that we are operating, or we will go to operate in the location with the right audience. That means people able to afford and to have a decent frequency on visiting Dunkin' and Domino. Today, for example, we are exploring more and more the North Coast. We have added new stores in the North Coast, and you know, this is a venue where, yes, the audience is Egyptian, somehow, let me say, A class, B class, but also there are a lot of international audience, especially now from the GCC. So basically, we are trying to penetrate area where there is a local good audience or an audience that is a local mixed with international audience.
Thanks a lot. That explains.
All right. I think we have a question on the chat box. So I think from Hadi Medat, Kita's entry into the market has led to a drop in delivery fees, which has impacted delivery revenue across the sector. Are aggregators now trying to ask restaurants like yourself to cover part of the delivery fee? So are you seeing any of that from your end?
Yeah, I mean, this, if you remember, we commented about this. So we commented, for example, also in the past few calls that today the customers are more and more sensitive to the delivery fees. And this is one of the key decision-making block that the aggregators are using also to protect the market shares. So we know by a fact that, for example, Kita, when they entered in Saudi Arabia, they came with a 6-month of free delivery campaign. That's why, again, back to the point about the cost per order, for us has been fundamental to reduce our cost per order because we knew that this was coming. So to be ready to absorb this decline. As well, that's the same reason why today we are also promoting more and more the carry out with a tip to the customers that is similar to the delivery fees. So basically the message to the customers is, dear customers, if you are not willing, let me say, to invest on delivery fees, so you know what, came to Domino, order your pizza, and we will reward you by giving back the delivery fees. So it's a sort of a compensation to the customers. And that is, again, it's important that today we can do this in a profitable way because we have been able to reduce the cost per order. So that's, again, the strategy of Alamar, but also is the strategy of the brand is to keep growing, to keep engaging with the customers, always by delivering an important value in terms of pricing, in terms of product, in terms of service.
All right. So I think in terms of the recovery, right, I mean, beginning of the year, did you anticipate a faster recovery than what you've seen? We are in August now. So the extent of recovery that you've seen now, were you expecting something better than this? And do you expect that some of this, I mean, to us, it seems a bit more gradual. Do you think some of it would be offset in the second half of the year?
I tell you, I mean, as we shared also in the graph that was updated until July, yes, there is a seasonality because now is a summer. We don't have the same audience like in the winter, but this summer is still performing better than the summer last year. So this confirm that the growth that we saw until H1 is still there. As I mentioned, we have now new tools available, either in terms of digital sales, CRM, but also new product. Now we are building important campaign. For us, the second half of the year is very important, especially from September onward, because there are important seasonality like national days, but also the back to school. And we are now engaging with all, preparing a plan for all this seasonality. So therefore, we do expect that this baseline will continue. We will do our best also to, let me say, to boost a little bit more the like for like. We need only to have some comfort in terms of, let me say, especially for the new product, to make sure that those new products are delivering as expecting, as well the engagement, the different engagement with a different audience will deliver as expected. So we will give you always more color when we do the call for the Q3. So in a way that you can keep tracking together with us the trend of the company.
All right, that's very helpful. I think let's see if we have any. So we have a question from Alovi. Alovi, please go ahead.
Hi, thank you for the call. I have two questions. In terms of I know there's a lot of moving parts, but in terms of your earlier expectations of returning to 2021 profitability by 2026, do you think it's still achievable given what's all happening? So that's my first question. The second question is in terms of the competition among aggregators. You see it's easing or it's more or less the same? And then once the Keith enters the UAE market, they expect to have similar gains from that? So those are my two questions.
I tell you, yes, we are still working to achieve the guidance, the mid-term guidance. This we believe is still feasible. In some specific months during the year, we saw this guidance already in our P&L. So this gives us the comfort that in a specific situation, the company is already now ready to achieve this guidance. For sure, we need some more growth. So that's why for us, the first step is to achieve 2023 and then to move to the mid-term guidance, because there are some costs that today we are bearing in our P&L that will remain the same also in the moment we increase the number of stores. For us today is very, very important to make sure that every new store is contributing to our P&L in terms of sales, but also in terms of profitability. So that's this is our key focus today. In terms of aggregators, I mean, the entrance of Kita in UAE, but again, this is my reading. I think that will be could be somehow different from Saudi Arabia, because also in UAE there is a clear player that is dominant. So will be very, very important to understand how this key player will react to Kita. As well, we know that somehow there is a bottleneck in the drivers. The manpower of drivers is not so available like in Saudi Arabia. That's why, again, our role, and this is how much important is our omni-channel business model, is yes, let me say, to use the aggregators, but also, let me say, to keep investing on our own channel. Again, today also giving a weight also to the carry out channel. So that's why, again, this omni-channel business strategy sometimes is very, very important to accelerate the growth. Sometimes help also to offset or to mitigate some risk, or to have, let me say, a better negotiation, to be better positioned to negotiate with others. So those are, let me say, the three important assets of this omni-channel business strategy. And this is today where we are focusing.
Thank you. One last question. In terms of the acquisition that you may complete, is this the right time to be thinking about acquisition, given where the share price is, and given that operationally you're not back to the same cash flow levels as back in 2022, 2021?
Yes, let me say the first acquisition, once we disclose, every one of you will understand better. But again, the first acquisition, we are not going to explore a new brand. We are only going to consolidate the market shares in our important market. And again, is a kind of acquisition that can help us also to generate a positive spillover in all the other markets where we are operating. So that's why it's something that really makes sense to do now. All the others, I mean, we are building the pipeline. As you rightly said, we will decide the right moment when to activate. Let me say, we don't have a sense of urgency to do an acquisition because we have a problem. We want to do the acquisition in the right time and also with the right brand and the right category. Making always sure that we are going to move in something that can be complementary, not to cannibalize what we have today.
Thank you. Thank you very much.
Thanks. So I think we don't have any further questions. I would like to thank the management for patiently answering all the questions and the participants. Any closing remarks, Filippo?
No, I wanted to thank all of you. I wanted to remind you that all of the materials will also be uploaded in our website. That myself, Mario, Arno, will remain available also for face-to-face meeting or call that we are going to participate in the coming few weeks in London. There is an important event where we can meet some of you also face-to-face. You will see, I hope, some announcement in Tadawul very soon. And again, after the announcement, as I mentioned before, we remain available to answer to any of your questions. And thanks, as always, for the support, the attention, and also for the questions that are always, let me say, exciting for us, and also to understand your view and how you are looking at us and at Alamar.
Thank you.
Recording stopped.